Today I'm talking about how to get double-digit gains in the sideways chop. There's been a lot of sideways chop overall. Yes, we came off of the most recent Trump rally, but it's been going sideways chop for a while. And if you look in history, there's always something going sideways. And so there's always something for us to get double-digit gains on. And so what I wanted to present to you today is, well, it's something I'm going to bring over here in front of my little slide that I'm showing. Let me verify that I'm actually showing this slide. Let me move some of these webinar pieces around. By the way, I do have a question for the folks that are on the line. I always like to know, just in case sometimes I start off and I don't even know how many people on the line. How many people on the line have heard of me before? AJ Brown from Trading Trainer. And what you can do here is on your webinar software, you know where you can type in your questions, but what you may not know is there's a little button there that you can use to raise and lower your hand. And oftentimes I like to know who's, I like to ask questions of you, and all I need you to do is raise your hand. So if you can find on your webinar control panel, there's like a, you'll notice if you're looking for landmarks, there's an orange button with a white arrow on it. And that orange button with a white arrow on it, if you go straight down from that, you'll see a button at the bottom of that column that allows you to raise your hand. So if everybody would try right now, I have really cool on my screen a list of all your names. It's almost like I have a little classroom dashboard, so I could tell whether you're raising your hand or not. So if you want to click that button right now, I'll actually see your name light up like you're raising your hand. Yeah, like that. Some of you have found that button. So cool, we can interact with each other, because it actually turns out that, you know, if I show you something on the screen, that's one thing. If you interact with me while you're learning about it, that's another thing. So let me put your hands down here. Different than being in a live classroom, I actually have a button that'll put your hands down. You can't do that in a live classroom unless you want to get in trouble for touching people inappropriately to push their hands down. How many with the show of hands have actually heard of me before? All right, and how many with the show of hands, I'm brand new to you? Fantastic, fantastic. Well, the scoop is I am AJ Brown, and I need to update my bio because it's been over 20 years that I've been doing options trading, and I've been doing them over 12 years professionally, meaning that I don't do anything else but trade options. In fact, this whole company, Trading Trainer, that I formed, it's very different than a lot of the companies you'd be dealing with in the education world, and that is that I have all of the profits of this company not going to my pocket, not going to my board of directors' pockets, but it goes to a charity where we teach inner city kids in Chicago how to do trading and how to do money management, just to get them off the street. And so that forces me and the folks that work at Trading Trainer to actually be proficient at what we teach at, simply because we wouldn't survive otherwise. This whole education thing is more of a passion for us than it is something that we rely on for income. We rely on our trading for income. Okay, so enough of an introduction of me. We have a program that we've been, one of the many programs that we've been doing since 2008, called the 6% Protocol. And it is a screener and videos and hand holding for covered calls and its variants. And this program, the reason why it's been going for this long and why people have been subscribing month in, month out, year in, year out, is because it works, right? But there's variants to these covered calls. Here's I've logged into the Learning Community web portal. You can see a picture of me from 10 years ago up in the upper right-hand corner. I'm a little bit more aged than that now. You can see the screener right here, and then under the Learning Center, you've got videos and videos of tutorials on how to do different types of trades. And then you even have the community forum where you can get private and public help. So if you have a trade you need to work through, you go through the community forum, and I'll step you through it. Usually what I wind up doing is just calling you on the phone and we work through the trade together. But in the meantime, what we wanted to talk about today is one of the variants. So how many of you with the show of hands are familiar with the whole cover call type process, or trading strategy, I guess is what some people would refer to it? I guess I should ask the other question. Let me put your hands down for those of you who said you know about covered calls. How many with the show of hands, you have no idea what covered calls is all about? All right, let me just give you a brief tutorial. Let me close this down for a moment. Let me just, I'm going to bring up a little just chalkboard, a virtual chalkboard here. So a covered call is where you buy a stock. So if you think the stock's going up or something like that, you'd buy this stock and then you would sell the call option against that stock. And what that creates for you is a lower cost basis. So for instance, if you were doing something like this, you would wind up basically getting a discount or a coupon for that stock. We call it our instant dividend. And what that instant dividend does for us is it allows us not only to automatically have some logged in gains for that stock, because if the stock is $10 and you get it for $9.50, you automatically have a 5% gain on it. But you also get a profit buffer. So if that stock goes down, you have a little bit of a buffer before you hit your break-even price. So it's a real nice strategy. It does have a place, you know, you can't get something for nothing. So what you do by getting that instant dividend is you do get a cutoff point where the profits don't occur anymore. We call that our max profit or our call out point. But other than that, it's a very fantastic strategy. And we try to pick the underlying symbol, meaning the stock or the index or the ETF, or in the case of the diagonal trade that we're going to be talking about today, which would be a deep in the money, far out in time call option, you try to pick one based on the underlying symbol's characteristics that most likely would keep you in what we call here at Trading Trainer our profit triangle, somewhere between the break-even price and the max profit price, because then you'll be able to cycle these things through and through every month or every week, depending on what kind of options you're trading, for multiple cycles. Does that make sense? How many with the show of hands does that make sense? How many of you with a show of hands, you're actually thinking through your head, you're like, that didn't make any sense at all. This guy talks way too fast. Well, let's just think about it in terms of owning real property. A lot of people buy investment properties and then they rent them out. And as they're renting them out, the rent surpasses the mortgage that you pay. And over time, your mortgage goes down and you're still collecting rents. That's basically what a covered call is. We're renting out the underlying symbol every month for a premium. And there can be a point where maybe the renters want to buy it, and we have to do that based on the definition, the standardized definitions of an option. But that's okay. And just to give you some statistics, when I do my 6% protocol strategy, and I do the monthly option, so every third Friday of the month, and that's just basically because I don't like to do much work to make money. And so I'm not looking for new underlying symbols all the time. In fact, all I'm doing is I'm checking in every evening for maybe about 2 or 3 minutes, and then I'm going on to the next day. So for this kind of laid back type of trading strategy, my statistics, as well as the statistics, I've kind of averaged the statistics of our clients over the last 9 years, is that on average we stay in any one symbol for about 4 to 5 cycles, 4 to 5 months. My goal, or not my goal, but my top number is that I stayed in one for 14 months. So every cycle I wrote premium. By the time 14 months goes by, you've paid down the underlying symbol. And then when it finally does get called out or you do decide to liquidate it, you get all 100% of the price of that thing because over the months you've paid down the cost basis. Makes sense now? How many with the show of hands does that make sense now? So let's run through a quick set of 10 criteria that I would use. This is not where I want to spend most of our time, but let's run through 10 criteria that I would use in order to determine that I'm on the right path here. So I'm going to pull out a notepad and we're going to type this together. Please have your notepad ready, because the first criteria I would use when I'm evaluating an underlying symbol is I would look at the Bollinger Bands over a 6-month period. So let me go ahead and log into the web portal, and let's go ahead and do that with one of our candidates. Login.tradingtrainer.com. We'll put in my username. We'll put in my password. And once we've logged into the learning community here, we'll go to charting. And then we'll go ahead. I'm going to pull up Coles because this is one of the candidates I'm going to feature today. This was identified by our screener, and we've been doing some fun trades on that. So I'm just going to pull up a chart on Coles very quickly. This quick review template is just a 6-month chart. It's on a linear, not logarithmic scale. We're going to switch it over to candlestick bars, but right now it's going to come up with open, high, low, close bar. And each bar is a daily bar. All right, so here's Coles. Let's go to the candlestick so it's easier for you to see. And then let's go ahead. First thing I said was the Bollinger Band set on a 20-day. And what I'm looking for when I see these Bollinger Bands, and let me see if I can't make those Bollinger Bands pop out for you. So I can change the color here, and I can make them nice and thick. How about that? So what I'm trying to do here is not get it when it's at its thinnest or its widest point. I want it to be kind of an average width. If you've got the Bollinger Band width measurement, that's sometimes an indicator that's available on your charting packages. You want it to be in the middle of the line or somewhere around the middle zone over the last 6 months. And you can just eyeball this. These are not things that you need to spend a lot of time with, you know, down to the 100th or 1000th of the decimal point. You just eyeball this. So Bollinger Bands width. And I also like to look at the candlestick count. Again, I'm trying to hedge my bets on finding something that's going to stay going sideways, preferably with a little bit of chop. So candlestick count is what I do. So I like to count how many candle bars since I've been outside of the Bollinger Bands. That would probably be right around here. And I'd like that number to be at least 20 or higher. That would really make me feel comfortable. Write this stuff down. How many with the show of hands got your pen cocked and your paper ready? You're taking notes here. Okay, let's go for number 3. Number 3, I like to look at the exponential moving averages. So I like to look at the 5, the 10, and the 20. This has a nickname. This is called the butterfly pattern finder. And this is not to be confused with butterfly option trading strategies. Let's actually go over to the tool. This is a free tool on the web, stockcharts.com. And we don't get anything for using their tool. I just like pointing it out because it is free and it is a very good charting package. A trading trainer gets no retribution for telling you about it. But let's pull up that Coles on stockcharts.com. In fact, I've actually got it loaded in on one of my favorites, the exponential moving averages. See if pull that up here. There it is. So when you look at the 5, the 10, and the 20-day EMAs, the butterfly pattern finder tells us when we're getting a little bit too consolidated and we're ready to break. Now, again, that's not what this particular type of strategy likes, is breaks. Okay, so in other words, in the traditional usage of this, you would look for a butterfly body where the 5, the 10, and the 20-day come on top of each other, and you would know when you're coming off of a wing like we have right here, that the body would mean that there's about to be another wing, and that's a breakout in the price. And that's not something we're interested in. So what we want to see when we use this particular indication is we would like to see the 5 and the 10, 20-day kind of passing by each other rather than consolidating on top of each other. Does that make sense? How many to show of hands say, yeah, I get that? Fantastic. Let's go ahead and bring back our list here. So the next criteria that I use in order to find good candidates to run these strategies on is I like to just look at a naked chart. That means I strip everything off of the chart, maybe even take volume off of it. No indicators to cloud my vision. And I'm simply looking to see, does it look like it's moving sideways? Does it look like it's moving sideways in a channel versus consolidating or diverging? Converging or diverging, we're not interested in. We just want to know, has this stock moved sideways? Has this index, has this ETF moved sideways for quite a while? Again, these are quick but powerful. Number 5, I like to take it to the next level, and I like to see if there's tested support and resistance. So again, with this chart up on us, what we like to do is make sure we've got a zone where we have tested a level of resistance a bunch of times over the last 6 months. And do we have that same sort of zone on the bottom half where we have tested support a bunch of times? Can I identify these zones quickly? I could every once in a while break through on the top or the bottom, but I want to know that I come back into that channel. Is there a support and a resistance line? Very important. Test number 6. I like to bring us over to the point and figure charts. So again, I can do that over at the free tools at stockcharts.com. They have a point and figure piece. And again, there's a whole bunch of other charting things out there, both free and part of your brokers and even for pay. But I like stock charts because it's just quick and easy. And again, I don't get anything from them. They've just been around since hammer was a hatchet. So when you take a look at Kohl's, on a point and figure chart, how many with the show of hands are actually users of point and figure charts or know about point and figure charts? I guess I should ask the other question. Let me put your hands down. How many of the show of hands have never heard of point and figure charts before? If you don't know about point and figure charts, I would tell you that when I started studying point and figure charts in the early noughts, so in 2001, 2002, a whole new way of looking at price action was opened up to me. Point and figure charts, of course, instead of incrementing along the horizontal axis based on time or date like a normal price and volume chart, the point and figure charts increment along the y-axis based on reversals. And where do reversals happen? Typically at support and resistance, right? So you wouldn't actually see an increment, one movement to the right, like you would on a price and volume chart for every daily bar, these bars or these columns occur after there's a reversal. And the column only has price action moving in one direction. So O's mean it's going down, and then after a reversal it comes up, and then after a reversal it goes down, and then up, down, up, down, up, down. And this could happen quickly or it could happen slowly. So for instance, they do, just for reference purposes, put the months, these are the numbers that are embedded into the chart, and the years, these numbers down at the bottom, to kind of show you what's been happening as far as when dates and times occur. So for instance, take a look at 2016. A lot of reversals compared to 2015. 2015 had fewer reversals throughout the year than 2016, and now 2017 we're giving 2016 a run. And then also you can see, for instance, what happened during January. So January, this is where the 1 started, was going down, and then when February started we went up, and then for some reason right at the beginning of March we started going down, but in March we continued, we reversed and went back up. April we started going down, and then May, actually April went back up, and then May we went down. June we've been up, down, and up again. So you can kind of see what's going on with reference to date. But what's really nice here is reversals, whether they be tops or bottoms, occur at lines of support and resistance. So we can get another way to look at where truly is the support and resistance, and where are we truly going sideways or not. Most powerful tool, a lot more you can do with point and figure charts. I suggest if you have some freedom and you want to get into a topic, that this is an area you focus, okay? Fantastic. So point and figure, let's go ahead and bring back our list because I got a couple more to go over. I like to also look at volume by price. This is a quantitative analysis trick or tool, and it's worth its weight in gold. So as you can see here, I've got an overlay price by volume. It should be volume by price. I don't know why they say that, but that's this volume bars along at each price. This is the amount of buying and selling that has occurred at that price. And again, as we know, if there's buying and selling at a certain price, that's where a line of support and resistance can occur, because there has been some price action and trading at that price. So I like to double check my support and resistance line that I find here on the price and volume chart with the support and resistance line I find on the point and figure chart, along with the volume at that place, and see if that truly is a line of support or resistance that people are subscribed to. Does that make sense? How many with the show of hands that makes sense? Excellent, excellent. Let's go on to the next one. The next one I like to call is my fractal patterns. See, I'm in it for the long haul. Let me tell you why. Let me take a quick tangent here. The 6% protocol, it got its name because if you focus on one of these, what we call theta decay trades, where 6% added to your portfolio every month is highly probable, then if you let that compound, the magic number of 6% per month compounded monthly comes out to doubling your money annually. See, that means that if you have a $10,000 account right now, at the end of a year, you'd have $10,000 in profit. And each additional year, as you let it compound, grows even more. And so we focus on this 6% protocol. And the truth be told, when we start to focus on things like our diagonal trade, our clients have been making more than 6% on their portfolio every month, in the double digits. And that means we get there even faster, right? If you start with $1,000, let me just pull this up really quick. That's going to be $2,012 in 12 months, $4,048 in 2 years. In fact, in 5 years, I mean, you're talking about some nice moolah that you can be doing part-time while you still do whatever you do. If you're a homemaker, that's fantastic. If you've got a day job, that's fantastic. If you're doing other investment strategies during the day, this is kind of the theta decay strategies. They require hardly any babysitting. 10 years, you're over $1 million, right? Just from original $1,000. And that's why people have been subscribing to this 6% protocol for 9 years now, because it works. Fractal patterns. So what are fractal patterns? That's where you take a look at your candidates and you don't just look at a 6-month daily chart. You look at a 2-year weekly chart and you see, does that same channel or does channeling at all play through? Because how you do anything is how you do everything. How a stock has been going for the last 2 years is just as important as how it's been going for the last 6 months. We're in it for the long haul. We're in it for the marathon. How about 10 years, looking at monthly charts? These are the fractal patterns, looking at different time periods using different period bars. You could even go the other direction and look at 30-minute bars and see if you see the same sideways channeling. I love doing this strategy on Kohl's. How many with the show of hands can see why? Let's go back to our 6-month daily chart. All right, fantastic. The next piece of our puzzle after fractal patterns is I actually like to do a little mathematical calculation. How many with the show of hands are ready for us doing a quick mathematical calculation? I want to take the channel width, so this area between support and resistance, and I want to figure out what is the percentage of this channel width versus the average channel price. So let me write that down for you. Average, not average, channel width divided by average channel price. Write that down, and then let's do it for reals on this particular candidate right here. So our support is about $37. So let's write that down. Support is at $37. Our resistance is at $40.50. So I take my calculator, and the first thing I want to calculate is the width. So $40.50 minus $37 gives me $3.50. I know, higher math right there. And then the average channel price, 37 plus 40.50 divided by 2 is $38.75. Let me stop right there. How many of you with the show of hands see how I got those numbers? So now I'm going to create a ratio of channel width over channel price. So $3.50 divided by $38.75. Got to make sure I'm in the calculator app. And that gives me about 0.09, or if you turn that into a percentage, 9%. So here's my rule of thumb for doing this strategy. I like it to be 10% or greater. 10 to 20% is the ideal average, or ideal channel width by channel price. So 10 to 20%, write that down in your notes. If it's below 5%, there's no way. I'm not interested in doing that particular candidate. When I get below 10% in that 10 to 5% zone, I kind of get the willies. I get the heebie-jeebies. So I'm not as interested, but 10% to 20% is the ideal range. So channel width divided by average channel price. Again, this is going to tell us whether or not we need to be worrying about it breaking away from being in its sideways choppy pattern. And finally, this is an easy one. I like to look up if it's got dividends. Why? Turns out that if a company is issuing dividends, the investors aren't going to put as much pressure, whether it be buying and selling pressures on the market or pressure on the board of directors to show some sort of asset appreciation, because they're fat and happy making dividends. So if they've got dividends, it's more likely that the company will continue to go sideways than it is for it to want to, you know, trend up or anything like that. So these are the 10 tests. You don't have to, you know, and as you can probably tell, they're not all black and white. There's some sort of area of gray of each one of these tests. But I like to run through these tests. And once you go through some spaced repetition and you learn how to do these tests, you can wind up evaluating a symbol in under 5 minutes with these 10 tests. You also want to pull up some of the soft data. You want to know if things that could be coming up in the future, like earnings or any sort of like product release or anything like that, might throw price off, because again, what we're trying to find is sideways channeling. So those are the 10 tests. Keep those down in your notes. That's going to help you a lot. So what, again, we're going to be doing here is selling the stock, buying the, buying the stock and then selling the call option. So for instance, one opportunity here might have been to buy the stock towards the bottom of its channel. So maybe down here at the $37 range, and then selling the call when the underlying symbol was closer to its $40.50 range. Maybe selling a call that's at the strike price of 40 bucks. And so whatever we paid, and so an example that we did was we wound up buying the stock, and we bought the stock on May 19, and then we sold that call option, the 40 call option, on June 2nd. The call option that was going to expire on June 16, which was yesterday. So June 2nd, we sold to open the calls June 16 $40 call option. And when we sold it, we wound up getting 70 cents for it. So we bought the stock and then immediately got 70 cents of a discount on it. Not immediately, because we bought the stock on May 19, and then on June 2nd, we got 70 cents back. And as you can see here, we did not close above $40. So this thing just wound up expiring worthless for us. And we're going to do it again in July. So we're already waiting for Kohl's to kind of peek its head up higher. And when it does, we'll go ahead and sell the July 40 or even higher. Whatever we can do in the month of July, we're going to do. Just going to keep selling premium cycle and cycle. The July options, remember, options, the monthly options expire every third Friday of the month. So in July, we're talking about July 21. So from now until July, we're going to look for an opportunity to sell that July option, make some more premium, lower our cost basis. But now here's where the real magic takes place. I can do so well. If you're doing the math in your head, you said, well, AJ, you probably bought this thing somewhere around $37. 70 cents back on $37 is not going to get me that 6% protocol you keep telling me about. Oh my goodness, that's not any good at all. And you might be right. So here's what my team and I have been doing. See, we can create a substitute for the stock by going deep in the money and far out in time with a call option. What this does to a call option, please take this down as a note, is it creates a price action that is similar, or if you're in option world, they call it at parity with the stock. So in other words, we actually, instead of buying to open shares of Kohl's on May 19, we bought to open shares of Kohl's January 2019. So these options are not going to expire until January of 2019. $25 calls. So make sure we go ahead and keep our nomenclature here. And what we wound up paying for these things was $12.20. So instead of paying $37, on May 19, we paid $12.20 for this deep in the money. That means the $25. If we were trading at $37, $25 is considered very deep in the money. Far out in time, so January of 2019, that's as far as we can go at this point. Call options. And this deep in the money, far out in time call option is going to act dollar for dollar with the underlying symbol. So if Kohl's goes up $1, so will this deep in the money, far out in time call, this leap option that we picked. So here's what's nice about it, is now our cost basis winds up being $11.50. Instead of 70 cents off of $37, it's 70 cents off of $12.20. Now you might say, well, but wait a second, your reward, if you get called out at $40, how does that work, AJ? How many with the show of hands were actually thinking that? Let's talk about the strict definition of a call option. If I sell somebody a call option like I did here on June 2nd, what's going to happen is somebody will want to come along and pay me $40, and they're going to want Kohl's. They're going to want me to hand over a stock. That's what they got. I'm obligated to deliver the stock for the price of the strike price, and that's why I got 70 cents. It's because I took on that obligation. So if somebody comes across, says, AJ, give me the Kohl's, I'm giving you the $40, I don't have the Kohl's. What do I have? I have the deep in the money far out in time call. With the deep in the money far out in time call, what's the definition of buying an option? When I buy an option with a American expiration, at any time I can go and give the strike price to the option seller. Here's my $25, and they have to hand over Kohl's, and that's what I got for paying them $12.20. So there you go, $12.20 minus 70, $11.50. If somebody calls me out at $40, I can immediately call the other person out at $25. I play the bank. I keep the spread. So max reward, otherwise known as max profit, comes out at $15. My cost basis, $11.50. So the gross profit, not including commissions, would be $3.50. If you turn that into a percentage to turn on return on invested capital, $3.50 minus or divided by the $11.50 amount that I invested, we're talking about 30% returns if I got called out. And that goes up each time the cost basis goes down. So in July, if I sell another 70 cents at the 40 strike price for July, and I get called out then, we're talking about now dropping us down into the $10.80 range. And each time the cost basis goes down, the return on invested capital goes up exponentially. So we're talking about 30.4%. Now you might say, well, what about the risk? Because of course the most important thing is not to focus on the reward, but it's to focus on balancing out the risk. My max risk, it depends on where you put your stop or your protective put. If you use a protective put, you've got to put the economics into the trade. But if we use just a simple stop, say for instance, we're triggered on, let's see, it looks like the lowest we've gone here. If I put my cursor right here, I can see that the low is $35.16. So if I go for a $35 trigger for getting out of a trade, my max risk would be $2 less than what I had purchased the leap at, $10.20, with my cost basis at $11.50. My max loss would be $11.50 minus $10.20, $1.30. And then if I do that as a ratio to cost basis, I have a 11.3% risk. And then of course, if you're balancing out your trade in order to get your position sizing, generally we say we don't want any one position to affect our portfolio by any more than 2%. In other words, I'd have to have 50 trades in a row opting out at max loss at our bailout price in order for me to eradicate my portfolio. I don't want any of this stuff where we put all of our money on soybeans and come back with like losing our house and things like that. So for instance, if we have 2% of our portfolio at risk at any one time, that's equal to the risk that we put into our trade times our position sizing. And that tells us we can put about 18%, 17.5% of our portfolio into this trade. We keep open a handful of these trades, probably about 6 or 7 of these trades a month. And that's where we can cumulatively grow our portfolio by 6%. How many with the show of hands think that we would have gotten stopped out at $35 this month? Yeah, highly unlikely. How many with the show of hands think that coming up in July, we could get knocked out at $40 based on the history you see here? And of course, that's going to change every day based on what's happening with coals. We'll check in with it every day for a few minutes. Yeah, a few of you do see the potential here. So that's really creating a diagonal. It's called a diagonal trade, but really what I like to call about it is just selling premium against a far out in time, deep in the money call option. That becomes a very valuable strategy, and that's basically what we're doing right now at the 6% protocol, and we've been doing it very successfully for the last 9 years. And I'd like for you guys to actually have an offer to be part of our 6% protocol program. We're offering a discount, especially now. We've gotten so much feedback from the existing folks that said, AJ, I've been with you for 9 years now, and you charge me every 6 months to be part of this program. Give us a break. We're going to be doing this for life with you. Let us have access to the screener, and let us have access to your coaching us individually through the trades. And so we actually just rolled out a lifetime access price. But what I'd like you to do is just go check us out. And so here is the URL. I had it up, but it looks like it's closed down. Well, let me go find it here. It's actually pretty straightforward, but let me see if I can pull it right back up here. Give me one moment. And if I can't pull it up, I'm just going to type it into my note area. Let's see if I can pull it up here. Here it is. From current slide. There it is. 6pp.today/investor masterminds. 6pp.today/investor masterminds. Come join us. This is a really easy strategy. And that's pretty much all the time I've got for you. I'm sorry I didn't get to answer any of your questions. Do me a favor, write down this email address, and you can send questions my way. In fact, I'll even throw in my phone number, aj@tradingtrainer.com, and my phone number, 970-266-8146. Give me a call, send me an email, I'll answer your questions. Otherwise, I look forward to you guys joining me at 6pp.today Investor Masterminds